trends in the size and composition of Australia's balance of payments. In this video, we will be looking at the trends in the size and composition of Australia's balance of payments, or the BOP. If you haven't watched the previous video on the structure of the BOP, you'll be confused very quickly, so watch it now. We're going to start by looking at the four recent trends in the balance of payments: international competitiveness, terms of trade, international borrowing, and foreign investment. The first trend has been international competitiveness. The OECD defines international competitiveness as a measure of a country's advantage or disadvantage in selling its products in the international market. Riley states two influences of Australia's international competitiveness are changes in relative inflation rates and the value of the Australian dollar exchange rate. Therefore, Australia will become more internationally competitive when domestic prices rise slower than its international competitors and/or the value of the Australian dollar falls relative to the currencies of its competitors. Let's now look at the data. The inflation rate from the IMF shows that Australia's rate of inflation was 2%, similar to that of advanced economies at 1.5%, though quite low compared to the rest of the world, 3.2%, and our biggest trading partner at 2.3%. Therefore, Australia is more internationally competitive because our prices are rising slower. Now, let's look at the Australian dollar from the RBA. Remember, Australia will become more internationally competitive when the value of the Australian dollar falls relative to the currencies of its competitors. It can be seen that the Australian dollar appreciated strongly in 2000, it then depreciated during the GFC, bounced back, but now is quite steady. This appreciation did not help Australia's international competitiveness. This will have the greatest impact in the trade balance of the current account. It will improve, i.e. not be in such a deficit when inflation is slower and the dollar falls relative to our export competitors. The second trend has been the terms of trade. A feature article on terms of trade published by the Australian Parliament House, APH, defines terms of trade as the ratio of export prices to import prices. If the index increases, it implies that Australia is receiving relatively more for its exports. An increase in export prices relative to import prices implies that Australia is better off, and vice versa. Looking at the data once again from our friends at the RBA, it can be seen that Australia's terms of trade are very volatile, or fluctuate a lot. This can be attributed to our exports, iron ore, coal, etc., being in a very volatile market. Prices for these commodities fluctuate a lot. The terms of trade will also impact the trade balance in the current account, as an improved terms of trade will improve the trade balance and thus reduce the CAD. This was evident in 2016-17, where the terms of trade had significantly improved compared to the previous year. This resulted in a slight surplus trade balance, which was a contributing factor to the CAD improving from negative 75 billion in 15-16 to negative 32 billion in 16-17. The third trend has been international borrowing. To finance the CAD, we, i.e. Australia, needs to borrow money. Now, as Australians are historically poor savers, we undertake international borrowing. There are two types of borrowing as shown in the RBA net foreign liabilities graph. First, debt. This is borrowing which carries with the obligation to pay interest and repay the principal. And equity. This is giving up part ownership of the business for funds. There is no need to repay interest or principal as a new foreign owner is entitled to profits as they are now a part owner. Add these together, net foreign debt and net foreign equity, and we get net foreign liabilities. Let's now look at the trends of these two types of borrowing. Net foreign debt. This has increased significantly since post-GFC. The concerns about this type of borrowing is the interest on these repayments aren't part of the net primary income debit, thus increasing the CAD. The increasing debt may impact our credit rating and increase the interest rates. Interest on these loans may increase and increase Australia's volatility to the international market. We are now more susceptible to shocks. Let's now look at net equity. In 2013, it went into the negative. Huh? This is good. It means our assets are greater than our liabilities. Guy Debble, Deputy Governor of the RBA, talked about this in April 2017. Since 2013, the level of Australia's investment in foreign equity has exceeded the level of foreign investment in Australian equity. Yay. This reflects the sizable offshore equity investments of the Australian superannuation sector, as well as foreign exchange valuation effects, with the depreciation of the Australian dollar since 2013. This is good news. Go us! The final trend in the BOP is foreign investment. Foreign investment fills the gap between what Australia saves and invests every year. The advantage of foreign investment in Australia include consistent economic growth, highly skilled workforce, strategic location, strong governance, good infrastructure, and a business-friendly environment. No wonder people want to invest in Australia. According to the ABS, the level of foreign investment in Australia was $3,192 billion for the year ending 31st of December 2016. Portfolio investment accounted for 52%, 1,659 billion. Direct investment accounted for 25%, 796 billion. Other investment for 524 billion at 16%, and financial derivatives at 7% of 212 billion. The leading investor countries for the year ending 31st of December 2016 were the United States of America at 860 billion or 27%, United Kingdom at 515 billion at 16%, and Belgium at 270 billion at 9%. This isn't necessarily a bad thing. The RBA acknowledges that investment has played an important role in expanding the economy's productive capacity to meet growing demand for Australia's goods and services. This is from DFAT, ABS, and the RBA. The RBA net capital inflows, i.e. difference between money in and out, shows the capital inflows can be summarised. Now, the capital inflows can be summarised from an abstract from an RBA bulletin in the June quarter of 2017. Capital inflows have underpinned the expansion of Australia's productive capacity for the past 200 years or more. Recently, there have been three noteworthy changes in the composition of these flows. First, most inflows to the mining sector are now direct funding from offshore, rather than reinvested earnings. Second, foreign investors have been more actively managing their holdings of Australian government debt securities. Third, regulatory reforms have led to changes in banks' short-term debt funding. So, the four trends, international competitiveness, terms of trade, international borrowing and foreign investment, have impacted the BOP, especially the current account. Australia's current account has been in deficit, i.e. the debts were greater than the credits, most of the time since 1960s. Remember, when the current account is in deficit, we call it a current account deficit, or CAD for short. The current account has been in surplus only 3 times since the 1960s, 62, 64 and 73. The rest of the time it has been a CAD. Focusing on the current account, let's summarise the factors causing the current account deficit into cyclical and structural factors. Before we do, though, the current account balance graph here uses percentage of nominal GDP. That is the value of the current account deficit that year over the total value of GDP. We'll be using this measure from now on as it provides the most accurate comparison across time and between countries. Since the 1960s, it can be seen that the current account, in green down the bottom, has fluctuated between just over 1% of GDP to negative 6% of GDP. Remember, the CAD has only been in surplus 3 times, 62, 64 and 73. The two components of the current account in the top part of the graph, it can be seen the trade balance, i.e. net goods and services, in orange, is a lot more volatile than net income balance, i.e. net primary income and net secondary income, in blue. So the cyclical factors, i.e. the factors that occur in cycles, are the fluctuating trade balance, fluctuating commodity prices, terms of trade, interest rate and exchange rate volatility. While the structural factors, i.e. the permanent reasons for this, are net income balance, the low levels of domestic savings and interest repayments to make the BOP equal 0. These interest repayments are part of the primary income. So, how does our current account compare internationally? Data compiled by The Economist shows that in 2017, the current account as percentage of GDP for some of the major economies was United States, negative 2.4% of their GDP, China, plus 1.2% of their GDP, Japan, 4% of their GDP, Britain, negative 4.5% of their GDP, and Canada, negative 3% of their GDP. While using data from the International Monetary Fund's World Economic Outlook and using the percentage of GDP, it shows the emerging markets and developing economies in red used to sit around negative 1% till 2000. Then it bounced up to 5% and now sits at about 0% again. The advanced economies in aqua sit at a steady 0%, while Australia is in the negative. So, what does the IMF's view on the CAD? In 2017, they released a paper titled Current Account Deficit, Is There a Problem? The author concluded, it all depends. They argue, if the deficit reflects an excess of imports over imports, it may be indicative of competitiveness problems, but because the current account deficit also implies an excess of investment over savings, it could equally be pointing to a highly productive growing economy. If, however, the deficit reflects low savings rather than high investment, it could be caused by reckless fiscal policy or a consumption binge. Or it could reflect perfectly sensible interportal trade, perhaps because of a temporary shock or shifting demographic. Without knowing which of these is in play, it makes little sense to talk of a debt being good or bad. Deficits reflect underlying economic trends, which may be desirable or undesirable for an economy at a particular point in time. It's very conclusive, eh? To conclude, the trend in the size and composition of Australian balance of payments can be classified into 4 categories: international competitiveness, terms of trade, international borrowing, and foreign investment. It can be seen there are both cyclical and structural factors for the current account deficit. Also, Australia compares okay internationally, while the IMF answers the question, is the CAD a problem, with it all depends.